Unrivaled Nation, I want to do an updated video on Dutch Bros BROS stock. This is a rapidly growing coffee chain. I've done a couple of videos on it already. So I did one right when they were IPOing. I did one earlier this year that covered their year-to-date results in 2023. And now I'm doing a updated video that covers their fourth quarter results and where do I think they go from here. Since my last video, when I called out that I actually like them, the stock is up a little bit. Now I want to revisit, based on their earnings, to think about what's the potential in the years ahead, and is it finally time to pull the trigger? So this is going to review the fourth quarter results. And, as I already mentioned, my first video on them provided an overview. The stock was trading in the mid 50s. And I said, you know what? It's just not that compelling. Subsequently, the stock did crash, dropped over 50% from that video. And so then I did that subsequent video. Stock did rally where I said, you know what? It's fallen enough based on their continued growth. I did like it when I called out that video. So I wanted to refresh the numbers based on their fourth quarter results. Is now finally the time to pull the trigger, based on the continued execution. So I, previously called out that I like it, but do I actually want to personally put capital to work into it? And I usually share, what am I buying and selling on a real-time basis with my subscribers at Unrivaled Investing. But I wanted to share my thought process with you on, what I'm looking for in terms of when to actually put when I put my own personal capital to work. So is this, are the fourth quarter results enough for me to pull the trigger, putting Dutch Bros in my own personal portfolio? I'm looking at the results broadly. 2023, that continued march higher, continued march, in terms of the improvement in fundamentals, which is what I like to see. You can see the number of stores, both company operated and franchised, up significantly. You're talking about revenues up around 30%. What I like to see. The contribution margin improving. Now there's a lot of adjustments, that go to this. That's why there's so many footnotes here. And, they talk about net income improving slightly from negative 20 million to 10 million, still very low figures, but talking about adjusted EBITDA, also a lot of adjustments going into that, going meaningfully higher as well. So largely the progress that I want to see, and that's what I was calling out in the last video. Looking at their same store sales, this is a key metric when you're sizing up a franchise type business like Dutch Bros, where, you own a bunch of boxes and you want to say, hey, what's driving the growth, which is going to be the number of new boxes you're going to open up, and how are the historic boxes that you've opened up performing? That's what the same store sales metric is supposed to track. The, after maybe you wait a year after it's been open, so that way you give it a chance to scale up. Let's compare how those boxes that are, let's say, a year plus or older, how are they performing? And so that's why same shop sales is a key metric to look at the underlying growth of the business and to see that this growth actually accelerated into the year with a 5% growth. This is what I like to see. So I quickly ask AI Ticker Chat, what is management explaining in terms of why their customer, their same shop sales is improving year to date? Because last year, the same quarter, you saw a decline. Why are you seeing this improvement? And it's really the trifecta that you want to see. You're seeing better traffic go through the store, so better customer initiatives to get the customers to come. They also had to do some pricing. They talk about raising pricing a couple percent, I believe around 3%, 300 basis points. And they also just keeping a fresh, innovative menu that keeps the traffic going. So those three key aspects, having good product drives traffic, and they are able to, pass on higher pricing. That's what's driving, and that's why you see this 5%. So broadly, very solid, and management's expecting continued store expansions in 2024 that should continue to drive growth. In this, they're talking about 150 to 165 new stores, and this translates into this, I'd argue, a reasonable outlook where they're saying, look, we're expecting to go from under $1 billion to roughly $1.2 billion in revenue, in 2024, low single digits in terms of same shop sales. So the stores that have been open for a while, that they're not growing at the 25% that this revenue implies, but the 25% revenue is because they're opening up new stores. And they're talking about EBITDA continues to expand, improve, but financing this growth is going to come at possibly some cash burn, because you're talking about adjusted EBITDA of, let's say, $190 million, but they're going to have to spend between 280 and 320 million to open up those new stores. So you are looking at a discrepancy between adjusted EBITDA and capital expenditures. That is important to understand, but still a lot of growth, and a lot of growth in the years ahead. I do like, when I'm looking for stocks, to be very clear, I want, management alignment, and I want to see something where it's obvious to me that this company could be much, much bigger in the years ahead. And management does a fair job making that clear, saying, look, we're targeting 4,000 stores. Look at how we've done. And based on their 800 plus stores now, that would pencil out multi-year growth trajectory, in the years ahead, and talking about where their margins could go. They talk about contribution margins of 30% plus, which, probably translates into 15 to 20% profit margins. But when I look at their actual profit margins today, the part that sort of bothers me a little bit looking at these results is that, in the fourth quarter, they only generated $2 million in operating profit, which was down year over year, and interest expense, which includes their leases, their lease liabilities, more than offset that. So you're really still talking about a business that's an unprofitable coffee chain. And meanwhile, they're going to reinvest, everything into store expansion. So that part does sort of rub me the wrong way. I wish, I want to see more profitability, is the truth. So where does Dutch Bros stock go from here? BROS ticker. First of all, in full disclosure, this is not financial advice. Also, quick plug, recently an Unrivaled investing subscriber posted in our exclusive Discord that this is a direct quote, I've recently paid my second annual subscription and couldn't be happier. I've profited enough already to cover the next 20 years of subscriptions. It's not hyperbole. I actually did the math. Come check it out yourself. That's unrivaledinvesting.com. There's also educational materials, which is what I wanted to know when I first started, working on Wall Street, both sell side and a multi-billion-dollar hedge fund. What is the information I picked up along the way that might be helpful for you in terms of reading financial statements or thinking about valuing stocks. So those courses are also available at unrivaledinvesting.com. Looking at the valuation framework. So the stock is up a bit since I called it out last, saying, hey, I think there's, significant upside. And so I'm trying to figure out, okay, do I want to make this part of my own personal investment journey? And I'm looking at the upside now, and I'm thinking, maybe they grow based on management's guidance, 25, 27% this next year. Long-term margins, maybe high teens, maybe even low 20s. They're nowhere near that now. And they keep growing at a 20% rate for the next 5 years. This is all like the optimistic take. And 30 times earnings multiple 5 years from now. And you're getting 130% upside. If you assume more conservative scenarios, you're down a bit over the next 5 years. I look at this and I think that's really not crazy compelling. So that's something that I want to think about. So this alone would make me say, I'm not sure I'd want to add this to my own personal investment journey, because penciling out 130% upside over the next 5 years, I'm not sure that's really enough to get me personally excited. Now, some people might say, hey, this is enough because I have super high conviction. I love my Dutch Bro drinks, so I'm gonna own it. I know it. I'm gonna own it. It's the Peter Lynch approach. And so that, I can understand why some people would do that. And keep in mind, this is a hypothetical framework. Stock price can go way higher, way lower. It depends on their execution. And they really need to execute very well in order to get really just, 100% upside. They need to have dramatic profit margin expansion in order to get 100% upside. And so I also run it through AI Ticker Chat. I go through one of our relatively new features, which is called Grade My Stock, to think about, okay, what are some of the other aspects to consider, or what do you think about the company more broadly? And, it's summarized, it's giving it a score. And this is something that we're going to refine, in the quarters ahead, but it gives it a score of 6 out of 10, saying, look, it has this compelling growth narrative, which I'm calling out, impressive revenue expansion, outpacing the sector considerably, which is, signs of it being an unrivaled business. And keep in mind, AI Ticker Chat's free for the first month, so feel free to check it out yourself. But it does talk about sky-high valuation metrics. Yes, there's a lot of Wall Street optimism with several analysts recommending a strong buy or a buy. But there's also a lot of insider selling and operational risk, getting to that profit margin that I'm just calling out that, gives it pause. And that's why it's not giving it, a really great score. So these are different items to think about, with, Bro stock. by considering Grade My Stock and thinking about it. And I think it has a very fine point here about the insider sales. I mean, there has been tens of millions of dollars in sales in just the last few weeks and months from the founders and insiders at Dutch Bros, and that is enough to give me pause. You know, when I see this feature is completely free on AI Ticker Chat. This is beyond the 1 month. You can check it out yourself under the fundamentals and insider transactions, so you can see what's going on here. And this bothers me, frankly, to see this much consistent selling. I would rather see a situation where, you know, an insider says, hey, you know, I've got enough. I own X percentage of the stock. And by the way, I don't need a huge pay package, and I don't need to constantly, you know, sell down my holdings. And so that bothers me. You know, like I called out a holding to my subscribers last few weeks where the founder owns something like 20% of the company. It's growing very quickly. It's profitable. And he said, you know what, I'm going to turn down this pay package because I don't want to dilute the company even more. And you don't see that very often. I'd say the other opposite end of the spectrum is sort of what you're seeing here with Dutch Bros, where you're just seeing tens of millions of dollars, you know, in terms of sales over time. And so that rubs me the wrong way as well. Also thinking about their profitability, and I think this is the final point that on why I'm not personally pulling the trigger, is, you know, you can see this historic data. AI Ticker Chat. I'm looking at Starbucks now, and you know, this is incredible in terms of their up and to the left or up and to the right, top right chart. You know, I love to see that, you know, that type of revenue growth, you know, and comparing where they were versus Dutch Bros, where Dutch Bros was doing $1 billion in revenue. Starbucks, around the same size, was 1997, 1998, so a long time ago. But even zooming back to that time frame where they were at, you know, a $1 billion revenue, they were still generating, you know, 8 to 10% profit margins. At least that's what I'm seeing here. Whereas with Dutch Bros, you're still talking about a business that's struggling to have profitability. So that's sort of the final nail in the coffin for me personally, in terms of not to pull the trigger. It's just say, like, your gross margins are similar. So does this reflect that you're just not being really disciplined about your cost structure? Or, you know, just paying out the executives, you know, a very lofty amount. So I'm looking at this, and I think this is a situation where you could have over 100% upside if management executes. But I'm not, you know, I'm personally looking for more. And I'm looking at a situation where their margins, you know, that needs to improve significantly. The historical precedent would suggest, hey, you should be at similar levels already. How come you're not? You know, how come you're not at that? So I have, for my own personal journey, I don't think I'm going to pull the trigger on Dutch Bros. You know, I previously called out that I liked it. I wanted to watch them keep executing. And I just don't think I've seen enough yet in terms of seeing that real free cash flow, seeing that real profitability for me to say, hey, I want to make this part of my own investment journey. That said, for others, I can understand why they say, hey, I really like the drink. The growth story makes sense to me. I think they're going to get to 4,000 stores over time versus their 800 plus now. So that growth projections and story, I can understand it. I can understand why someone else will have it part of their journey. It's not right for me. And if you have a different take, I'd love to hear it in the comments below. And thank you so much for watching Unrivaled Investing.